Welcome back to Tesla Daily News Podcast. Today is January 17th, 2026, and we've got several Tesla developments that matter for revenue, margins, and the long-term valuation story, especially around software, supply chain control, and global demand. Today, we'll break down Tesla's move to make full self-driving subscription only, a big new update on Tesla's Texas lithium refinery going live, the latest on price war pressure in China, signs of demand friction in India, and a quick look at competitive heat in the EV market, plus why safety rankings and charging expansion still matter to the brand and sales funnel. Story 1. Tesla just made its most important software business more like Netflix, and investors should pay attention. The hook. Starting February 14th, Tesla will stop selling full self-driving as a one-time purchase and only offer it as a monthly subscription. Context. Tesla's valuation has always leaned heavily on software and autonomy. Wall Street tends to award higher multiples to recurring software revenue than to one-time, optional upgrades, but the trade-off is near-term cash flow timing and potential customer backlash. Details. Elon Musk confirmed on X that after February 14th, full self-driving will no longer be available as a one-time buy. Multiple reports cite the current U.S. pricing as about $8,000 to buy outright today, or about $99 per month as a subscription. Impact. For the stock, this is a classic revenue quality move. Subscriptions can smooth revenue over time, raise lifetime value per vehicle, and potentially reduce the boom and bust pattern of end-of-quarter FSD pushes. But it can also create a short-term incentive spike. Some buyers may rush to purchase before the cutoff date, followed by a dip as the backlog clears. The bigger question for investors is attach rate. If subscription-only pricing raises adoption, because paying about $99 per month feels easier than writing an $8,000 check, Tesla could increase the share of its fleet generating high-margin software revenue. On the other hand, if customers feel like Tesla is taking away ownership, adoption could fall. Takeaway. Mark February 14th on your calendar. Watch for two things. First, a possible short-term bump in other automotive revenue tied to FSD purchases before the deadline, and second, whether Tesla later tweaks subscription pricing, bundles FSD with financing, or introduces tiered autonomy packages to protect adoption. Story 2. Tesla's Texas lithium refinery is now in production, and this is about margin defense, not hype. The hook. Tesla confirmed its lithium refinery in Corpus Christi, Texas, has officially begun production. Context. Batteries are the biggest cost driver in EVs. Tesla has argued for years that lithium isn't rare. Refining capacity is the bottleneck. Owning refining is vertical integration aimed at stabilizing input costs, improving supply security, and reducing exposure to geopolitical and commodity shocks. Details. Tesla released an official video showcasing the Corpus Christi facility and stated it is now producing. Tesla framed it as a step toward North American energy independence, with regionalized access to critical battery minerals. Impact. For investors, the key is gross margin resilience. If Tesla can refine battery-grade material domestically and at scale, it may reduce costs per kilowatt-hour over time, or at least reduce volatility. That matters in a world where EV pricing is under pressure and competitors are willing to sacrifice margin to gain share. This also supports Tesla's long-term capacity goals. Even if demand is cyclical, supply chain control can be a strategic advantage, especially versus automakers that must buy cells and materials at market prices. Takeaway. This isn't likely to move quarterly earnings immediately, but it strengthens the manufacturing plus supply chain moat narrative. Watch for Tesla to disclose throughput, cost targets, or expansion phases. Those details will determine how much margin protection this actually delivers. Story 3. China is warning automakers about the price war, and Tesla is right in the middle of that battlefield. The hook. Chinese regulators are warning of severe penalties for automakers as a fresh round of price cuts escalates. Context. China is the world's most competitive EV market. A prolonged price war squeezes margins and can pressure Tesla's profitability, even if unit volumes hold up. Details. Reports indicate regulators signaled they want to curb excessive competition and may penalize companies continuing aggressive price cutting. Impact. If China actively tries to cool the price war, that could be a net positive for Tesla's margins, but only if enforcement is real and broad, including domestic champions. If it becomes selective or unpredictable, it adds policy risk. For Tesla investors, this ties into near-term earnings quality. In a heavy discount environment, Tesla can maintain demand, but at the cost of automotive gross margin. Any credible policy shift that stabilizes pricing could help sentiment. Takeaway. Watch China pricing moves closely over the next few weeks. If discounts narrow across the market, it could signal margin relief. If discounts continue despite warnings, assume the price war remains a headwind. Story 4. Tesla's India launch is facing a reality check, and inventory discounting is the red flag. The hook. Tesla is reportedly discounting unsold Model Y inventory in India after a letdown following its official launch. Context. India is a massive long-term market, but it's also price-sensitive, policy-complex, and very competitive in the mid-range. Early demand softness can imply product-market mismatch, weak charging coverage, or pricing that's too high relative to local alternatives. Details. Reports say Tesla is offering discounts on unsold Model Y inventory. Impact. Inventory discounts usually mean either demand is below plan or supply was front-loaded. Either way, discounting pressures margin and can complicate the brand's premium positioning in a new market. The upside is that Tesla can use pricing strategically to build a fleet, which later becomes a software and services base. Takeaway, for investors, India remains more of a strategic option value story than a near-term profit driver. Watch whether Tesla localizes production or secures policy wins. That's what would change the long-run economics. Story 5. Competition is tightening, and it's not just one rival. The hook. Multiple competitors are closing in around Tesla's core segments, from new sedans priced near Model 3 to new electric SUVs targeting Model Y. Context. Tesla's biggest moneymakers have been Model 3 and Model Y. When competitors match range, features, and price, Tesla's differentiation shifts to software, charging, manufacturing efficiency, and brand. Details. In Australia, Mazda's upcoming 6e has been spotted testing, with an indicated estimated price around $55,000 before on-road costs, roughly in the same range as the Model 3 rear-wheel drive, reported around $54,900 before on-road costs, and the BYD Seal Premium around $52,990. Separately, Rivian has started producing validation units of its upcoming R2 electric SUV and says customer deliveries are expected in the first half of the year. Impact. None of these announcements alone breaks Tesla's thesis, but together they reinforce a reality. Tesla can't count on being the only compelling EV anymore. In that environment, recurring software revenue like FSD subscriptions and cost control like lithium refining matter more. Takeaway. Expect competitive pressure to keep Tesla disciplined on costs and potentially aggressive on pricing. For Tesla, margins and software adoption are the key swing factors. Story 6. Brand and ecosystem updates, charging expansion, and safety narratives still influence demand. The hook. Tesla opened a new supercharger station in Afyonkarahisar, Turkey, while Euro NCAP's latest, best-in-class, safety spotlight went to Mercedes. Context. Charging availability is a demand lever. It reduces range anxiety and expands addressable markets. Meanwhile, safety recognition influences consumer confidence and can shape press narratives around advanced driver assistance. Details. Tesla expanded its charging footprint in Turkey with a new supercharger location in Afyonkarahisar, a strategic corridor city. On safety, Euro NCAP named the Mercedes-Benz CLA as the top overall performer in its latest set of category winners, with EVs prominent across categories. Impact. Charging build-out supports sales conversion and long-term services revenue. The safety headline, however, is a reminder that competitors are investing hard in advanced safety systems and testing performance. That matters because Tesla's autonomy story sits under constant scrutiny. Takeaway. Investors should treat charging expansion as steady, compounding infrastructure advantage, and treat safety headlines as narrative risk that can influence consumer sentiment and regulation. Before we wrap, one market signal worth noting, Cathie Wood's ARK Invest reportedly continued trimming Tesla shares while shifting into other names. That's not a fundamental change by itself, but it can affect near-term flows and sentiment among retail and growth investors. Recap for today. Tesla is leaning harder into recurring software revenue with FSD going subscription-only on February 14th. It has a newly operating lithium refinery in Texas aimed at protecting battery economics, and it's navigating both global price war pressure, especially in China, and demand challenges like reported Model Y discounting in India. Meanwhile, competition is tightening around Model 3 and Model Y, making cost discipline and software attach rate even more central to the Tesla thesis. For tomorrow, keep an eye on any follow-up details about FSD pricing tiers, regional pricing moves in China, and whether Tesla provides more specifics on refinery output and scaling plans. That's it for Tesla Daily News Podcast. If you want daily, stock-relevant Tesla updates in one place, subscribe and follow, and we'll be back tomorrow.